Hey everybody, Steve Ankerstar here. Just want to give you a quick update on the markets. Obviously, we're a couple weeks into January here, and it has been significantly different than other years in the fact that we're already fairly well into the red for the year and could spend a while climbing out. So I wanted to, people have been asking me kind of the same questions all along, what's causing it? Is it inflation? Is it the Fed? Is it COVID? Let's talk to all that real quick, and then I will hopefully answer all of y'all's questions, if you will, Texas term, all y'all. But to kind of get to the bottom of where do I think the market is and where do I think it's going, I will say, and I'll show you a chart, that we are at a pretty major inflection point after today. So let me kind of pull up CNBC here real quick for you and show you a couple things. So there you go. There's the big ugly numbers for today for the Dow, the S&P, and the NASDAQ. NASDAQ, obviously worst of the three, down 2.6%. And, that takes us right to that correction point. So we're already in just a couple of weeks off 10%, really from its most recent highs. So I will show you that here in a second. So what's causing it? We'll address that first, and then I'll show you the charts about where we're going. There's still some hangover of tax reform that didn't get passed in the Build Back Better plan and all of the scary stuff from the blue wave from last year. I think tax reform is off the agenda. I think now that we're in the year of the midterms, that nobody's going to, from either side, is going to push for major tax reform right before another contentious midterm election, right? So I think tax reform's off the table. I don't think that's affecting the market at all. Okay, how about COVID and specifically Omicron? Well, Omicron, if what we are understanding about it is true, is largely it's not as severe. So people aren't necessarily dying from it like the major strains, but certainly it's spreading it seemingly faster. It seems like everybody has had it or is going to get it, and that it's going to burn itself out from the folks that have said, well, everybody just needs to get it so we don't have to worry about it. So that, who knows exactly how it will play out. I'm not here to debate either side of that. I am here to say that that's largely not affecting the markets either. If anything, it's helping the market because the future variants of COVID are not as severe. We can all kind of deal with illnesses where people aren't dying at the end. That's my opinion, versus illnesses where lots of people are dying, right? So if it turns out to be less severe over time, it's just not going to be a factor for the markets directly. There could be some indirect second, third order effects, but a direct impact to the market and shutting down economies just not going to happen anymore. So that brings us to really what's causing all this is there's the inflation, which if you call that the disease, the inflation has people concerned. And then you have the cure, which, you've heard the old phrase, the cure can be worse than disease. And I think that's actually what we're seeing right now. And that's what's driving the sell-off. So let's peel that back a little bit. So in this case, the disease is inflation. Last year, we had 5.9% inflation. So obviously that's a huge move up, I think to the tune of, if I remember right, 40-year high in inflation. And we're probably going to have that this year. That's kind of a given, I think, regardless of what we do. But a lot of spending. I know you've seen the deficit charts and the amount of money that's has flowed into the economy, and yeah, we were due for some inflation, right? How could we not get inflation out of all that? But now that we actually have it, what to do about it? Well, the cure in the Fed's double mandate of full employment and keep inflation under control. Part of the keeping inflation under control, the only tool they have, is they can taper the bond buying program, which they're doing, and then they could also increase the interest rates. Well, increasing interest rates is kind of a hammer where everything becomes a nail. So that's what they're already talking about. That's what's hitting the markets, is not the inflation itself, it's the cure. It's the actual raising of interest rates. Now, what is not widely understood, unless if you understand this, then you are well ahead of the curve, I will say, is that interest rates move based on a market. The only real one that's being adjusted is the 2-year interest rate by the Fed. That's the one that's being manipulated. If my little breaking banner kind of went away, no, it's below. If you look right here, I'll try to highlight it without sending us off this page, but 10-year yield rises to a 2-year high. That's important for you to understand, is the Fed hasn't made any moves yet. All they've done is talk, and the 10-year yield is already at a 2-year high, which is still pretty low. But all that refinancing window, all that stuff, you can expect that to be gone, probably gone for a while are gone for good, if you will, even if the Fed doesn't raise rates. So that window is closing. That is a market-based number. So you can expect to see interest rates across the yield curve all the way, 10-year, 30-year and everything to creep up because we have inflation, not because the Fed's driving interest rates higher. So how do I think this all plays out? I think there will be lots of talk from the Federal Reserve about raising interest rates. I think that they will not raise. They forecasted 3 a year this year, basically 1 every quarter. I don't think they will do any of the 3. I think they know that they know that when they do, it's going to crush the markets, and nobody wants to be the person responsible for crushing the markets right in front of an election. Now, I'm not saying the election's an excuse. I'm just saying it's a fact that that's coming, and who wants to be the person to do that? So also we have the deficit, and interest on that is based off of interest rates. So why would we all of a sudden start jamming interest rates higher? And well, now we have to spend more of our money covering our own previous spending. I just don't see it happening. And if it does, I think the market will the market's already kind of pricing it in. We're already, the NASDAQ's off 10% already. When this happened, and so the case study for this is 2018. When this happened, they did 3 interest rates inside of a month, or 3/4 of a point, if you will, and the market went down 19% in a month. So pretty aggressive market reaction. So the market's already kind of reacting to this. So if they actually do raise rates, then you'll see the market continue to sell off a little bit. But if they don't, then you're going to see the market turn around, flip, and run higher. That is what has traditionally been happened, and has happened under a zero interest rate environment, which we're still in until they actually raise rates. So that's my take on the issue. I want to show you a couple of charts, and then we can see why, or you'll see why I'm saying today is an inflection point because of where we are. So this is ThinkPipe's TD Ameritrade chart. When you look at this, this is a 9-month chart of the S&P 500. Every single trend line on here is up. Boom, we just busted out the bottom of that trend line. So one of two things will happen tomorrow. I doubt tomorrow is a boring day. One of two things is going to happen. Most of us are of the buy the dip mentality that whenever it hits this bottom line, the market turns around and flips higher. Okay, so I did have a client, gutsy call a few minutes ago, text me and says he's calling the bottom. I'm not going to get into daily calls, but I am calling a big day tomorrow because either everybody believes that this is the buy the dip the moment. I did some buying today. I have some more buying to do tomorrow. But if this does not hold and we actually break that trend to the downside, I think we could fall for another 4 or 5%. So again, here we're looking at the SPY, which is a little different chart. We're only around that 4% off from the high in the SPY. The real blood has been, and which these have the chart. So this is the QQQ. So let me show you. So this is the SPY. So when you look at this chart, all the way back here, these blue things are a day. So a little over a month ago, we were below this, ran all the way up here, and we're back down to where we were a month ago. When you look at the QQQ, we climbed up here. We hit new highs towards the end of last year. That is, 1228. There you go. Right around last trading day of last year. And then, is it? Nope. Second to last, third to last. So the last week of the year, I can say that honestly without tearing the chart apart. But yeah, got new highs the last week of 2021. And then really, we went down. This was an intraday low about a week ago. Nobody really talked about that because it closed way up here. It bounced hard during the day, but we've broken down to where we're past the low we had a little over a month ago, and we're approaching a recent intraday low that we've already had this year. So everything on this chart tells me there's your big green bounce after today. But I'm not calling that. I'm saying that if it doesn't bounce tomorrow, I think all of the people that put their faith and belief in that this was the bottom are going to be unhappy and have to do some forced selling at that point. Ideally, not ideally, but they're selling because a lot of clients are like, nope, don't want any more of the pain, so let's sell. So just because an advisor selling doesn't mean the advisor wants to sell. But I plan to hold our tech through this. We're only in the best of breed positions. So that's my plan. If you don't like that plan, then please reach out. We can discuss the plan. And ultimately, you're the client. So if you want to go to safety here, because 2022 is a lost year, well, I'll try to talk you out of that. But at the end of the day, you make the call. So that's what I want to share with you today. Thanks again for listening in. I think tomorrow is going to be very interesting as far as, well, it'll be forecasted in the future. So when you get up tomorrow, if you get up nice and early, you can see how things are trending well before the open. But we shall see. It'd be a good day to watch it closely, or not if you're sweating the daily motion, if you will. So that's all I've got for you. Thanks for listening in. And again, I'll start putting these out more on a regular basis now. We've, as a company, we've brought on a lot of things and done a lot of things differently. I need to get these out a little bit more to help answer people's questions. So thanks for listening in. We'll talk to you soon.